Open the financial news any given day, and you are hit with a barrage of noise. Conflicting headlines, earnings whispers, and geopolitical panic constantly collide. Most retail market participants look at this chaos and try to guess what happens next. They believe that extracting money from the market requires predicting unpredictable future events. This candlestick chart reveals the reality of short-term pricing. When you strip away the ticker symbol and the news alerts, you are left with pure price action. In the short term, a severe downtrend is often disconnected from corporate logic, driven instead by supply, demand, and immediate human sentiment. Notice how the actual price fluctuations deviate from this flat line, which represents the company's theoretical valuation. Because short-term price factors ignore these anchors, analyzing corporate earnings is often useless for navigating immediate market movements. Professional traders do not attempt to predict the future. They execute mechanical systems built entirely on statistical probabilities. A systematic trader operates on a model that differs from a traditional investor. An investor evaluates a business to own it. A systematic trader builds a framework to exploit temporary pricing inefficiencies. This approach requires stripping away human emotion. Every entry, exit, and risk parameter must function like this mechanism, operating with strict mathematical architecture. To understand this process, we are going to engineer a complete swing trading system from scratch. We will define the structural cycles of price movement, detail the mechanics of leverage, and establish the algorithmic constraints that prevent terminal loss. Over a multi-year timeline, a stock's trajectory is tethered to its corporate valuation metrics. That remains the domain of the traditional investor. Long-term value investing, exemplified by Warren Buffett, provides a strategy for decades-long wealth accumulation. But evaluating a company's 10-year cash flow does not help extract yield over the next 10 days. Extracting consistent yield from short-term market noise requires abandoning traditional valuation in favor of structural logic. Market pricing does not move in a straight line. It expands and contracts in identifiable structural cycles. This graph illustrates the mechanics of an objective uptrend. Think of it like a breathing pattern. The price expands upward, contracts slightly downward, and then expands higher again. Mathematically, it is a sequence of higher highs and higher lows. The upward expansion is the impulsive wave, the momentum driving with the overall trend. The downward dip is the corrective wave, a temporary retracement against that momentum. Underneath this price action, we can plot dynamic support boundaries. These three curving lines represent the 50, 150, and 200 period moving averages. A systematic model avoids buying the peak of an impulsive wave. Instead, it targets the exact intersection where the nadir of the corrective wave touches one of these moving average lines. Identifying this specific structural cycle dictates exactly when the system enters the market, stripping human emotion from the buying decision. A complete system must possess mechanical symmetry. If assets drop in price, the system must extract profit from falling trajectories as efficiently as rising ones. This flowchart maps the mechanics of short selling. To profit from a decline, a trader borrows a block of inventory, in this case 100 shares, directly from a broker. The trader sells those borrowed shares on the open market for a $2,600 credit. When the asset depreciates, they repurchase the shares at $20, spending $2,000 to return the inventory. The difference leaves a $600 profit. Executing these trades with standard, unleveraged capital introduces low capital velocity.
Capturing minor short-term price swings with pure cash often yields inefficient returns relative to the time invested. This gauge shows the solution, utilizing contracts for difference or margin accounts. To control a $2,900 position, the system doesn't deploy the full amount. It requires a margin deposit of 10%, or $290. By deploying only a fraction of the capital, a 24% price move in the underlying asset transforms into a 241% return on the invested margin capital. This architecture operates with a specific vulnerability. Leverage is perfectly symmetrical. If a trade moves against the system, losses multiply at the same rate. A 10% adverse price swing will annihilate 100% of deployed capital. Because leverage introduces the threat of terminal account ruin, it is impossible to use it safely without rigid algorithmic risk constraints. Preventing terminal ruin requires a position sizing algorithm, the engine that determines the scale of every market entry.
This visual equation outlines the first step. We define an absolute maximum allowable drawdown for any single trade. With a total capital pool of $5,000, we lock in a risk parameter of exactly 2%. Multiplying those figures reveals a hard boundary. The maximum risk capital constraint is exactly $100. Before any capital is deployed, we map the structural boundaries on the price chart. We plot an entry order at $90 and an invalidation stop-loss line at $87. The mathematical distance between the entry point and that failure point is the risk per share. Here it is $3. The core algorithmic constraint executes by dividing the total allowable risk by the specific risk per share. We divide $100 by $3. This formula outputs the non-negotiable position size for the trade. The system constraint dictates the purchase of exactly 33 shares. Mitigating loss is only half the equation. The system also utilizes the R multiple, a principle dictating that target profits must be structured as asymmetrical multiples of the baseline risk. If the baseline risk, or 1R, is $3 per share, the target profit must be strictly set at double that distance, projecting a target price of $96. In a professional system, the number of shares purchased is a pure mathematical output dictated by the distance to the trade's failure point. This framework operates on the same logic as a casino. The house does not know the outcome of any individual spin of the roulette wheel, nor does it care. This grid displays the concept of statistical expectancy across a larger sample size, representing a sequence of 20 hypothetical system executions. By enforcing our R multiple constraints, we can observe the math of a moderate 60% win rate. 12 wins, yielding 4% each, are tallied against 8 losses costing 2% each. When we tally the totals, the geometric advantage is clear. The 48% gained from the wins easily absorbs the 16% total cost of the losses, resulting in a net 32% return. The ultimate stress test occurs when the system is wrong more often than it is right. We shift the grid to a 40% win rate, 8 wins against 12 losses. Even with a sub-50% win rate, the mathematical asymmetry holds. The portfolio absorbs the high volume of failures and resolves to a positive 8% net return. The system survives adverse conditions because these mathematical parameters act as an unyielding, protective cage around the capital. This approach requires the psychological discipline to apply these formulas over thousands of iterations, regardless of short-term streaks or individual trade outcomes. These precise mechanical constraints are the underlying architecture, driving the vast volume of the global financial exchanges. Portfolios survive absolute uncertainty by adhering to mathematical constraints, treating every trade as a single data point in a much larger sequence.